In 1998, a hedge fund run by two Nobel Prize-winning economists lost $4.6 billion in less than 4 months. These weren't amateurs. They had literally won the world's highest academic honor for understanding financial markets. And yet, they nearly collapsed the entire global financial system. The problem wasn't that they weren't smart enough. The problem was that they were too smart. Here's something nobody tells you. Intelligence and wealth have almost no correlation once you pass a certain threshold. Research from the Swedish military, which tested over 59,000 men, found that cognitive ability predicted income, but only up to a point. After an IQ of about 120, the correlation disappeared completely. Some of the wealthiest people scored average. Some of the highest scorers earned modest incomes their entire lives. Why? Because making good decisions with money isn't about being smart, it's about behavior. And intelligence actually introduces 3 specific traps that sabotage financial decision-making. The first is what psychologists call the overconfidence effect. Smart people are used to being right. They've spent their entire lives getting rewarded for having the correct answer faster than everyone else. This creates a dangerous feedback loop. Success in one domain makes you believe you'll succeed in all domains. Daniel Kahneman, who won the Nobel Prize in Economics for his work on cognitive biases, describes this in his book Thinking, Fast and Slow. He explains that experts are often the worst at recognizing the limits of their own knowledge. A surgeon might be brilliant in the operating room but assume that same brilliance transfers to picking stocks. It doesn't. Picture this scenario. Imagine someone who graduates top of their class from an elite university. They land a high-paying job in consulting or tech. Within a few years, they're making 6 figures. They look at their investment portfolio and think, I optimize supply chains for a Fortune 500 company. How hard can investing be? So they start trading. They read articles. They follow market news obsessively. And because they're intelligent, they can construct elaborate rationales for every decision. The problem? They're competing against algorithms and professional traders who've spent decades doing nothing but this. But intelligence tricks them into thinking they have an edge when they're actually just gambling with extra steps. This is the intelligence paradox. The same cognitive horsepower that helps you solve complex problems also gives you the ability to rationalize terrible decisions. You're not just wrong, you're wrong with confidence. Let's return to that 1998 disaster. The fund was called Long-Term Capital Management, or LTCM. And it wasn't just run by smart people. It was run by legends. Myron Scholes and Robert Merton had won the Nobel Prize in Economics in 1997 for developing the Black-Scholes model, a mathematical formula that revolutionized options pricing. John Meriwether, the founder, was a bond trading legend from Salomon Brothers. The team included PhDs from MIT and Harvard. If there was ever a group of people who should have been able to predict and manage financial risk, it was them. For the first few years, LTCM was unstoppable. In 1995, the fund returned 43%. In 1996, it returned 41%. Investors were begging to give them money. The fund's strategy was built on complex mathematical models that identified tiny pricing inefficiencies in global bond markets. They used massive leverage, sometimes borrowing $30 for every $1 of actual capital, to amplify these tiny edges. Here's where overconfidence became fatal. The models said their strategy had a 1 in a billion chance of catastrophic loss. Those odds felt safe because the models were built by Nobel laureates. But the models made an assumption that markets would behave rationally. In August 1998, Russia defaulted on its debt. Panic spread. Investors fled to safety. The tiny pricing relationships that LTCM bet on didn't just narrow. They exploded in the wrong direction. Because the fund was so leveraged, small losses became enormous in a matter of weeks. In a matter of weeks, LTCM lost $4.6 billion. The fund was so deeply embedded in global markets that its collapse threatened to trigger a chain reaction. The Federal Reserve had to organize a $3.6 billion bailout by 14 major banks. Myron Scholes later admitted the fundamental mistake. We thought we had found a free lunch. We were wrong. Their intelligence allowed them to build incredibly sophisticated models. But that same intelligence blinded them to the models' limitations. They mistook the map for the territory. They believed their equations captured reality, when reality is always messier than math. This is the danger of genius-level confidence. You become so convinced by your own reasoning that you stop asking, "What if I'm wrong?" The second trap that catches smart people is analysis paralysis. When you're intelligent, you can see more possibilities, more angles, more potential outcomes. This sounds like an advantage. Barry Schwartz documented this phenomenon in his book, The Paradox of Choice. He describes how having more options doesn't make us happier or more successful. It makes us anxious and frozen. We become so focused on making the optimal choice that we never make any choice at all. Consider investing. A person of average intelligence might read that index funds are a good long-term investment, buy a simple target date fund, and move on with their life. They'll probably do just fine. Studies consistently show that low-cost index funds outperform most active investors over time. But a highly intelligent person? They go deeper. They start researching. Should they weight towards value stocks or growth? Domestic or international? What about emerging markets? Small cap tilts. They read about factor investing, efficient frontiers, and tax loss harvesting strategies. Months pass. They still haven't invested. Meanwhile, the market goes up 10%. They've lost money by being too smart to start. Research by Terence O'Dean at UC Berkeley analyzed over 66,000 households with brokerage accounts between 1991 and 1996. He found that the investors who traded most frequently, who were actively trying to optimize and outsmart the market, underperformed the simple buy-and-hold investors by 6.5% annually. The frequent traders weren't dumb. They were engaged. They were informed. They read financial news. They had theories. But all that thinking actually hurt them. Every trade cost money in fees and taxes. More importantly, every trade was an opportunity to be wrong. The investors who did nothing, who were perhaps too simple or too busy to overthink it, came out ahead. This is analysis paralysis in action. Intelligence gives you the capacity to consider endless scenarios and second-guess every decision. But in financial markets, the person who waits for perfect information never invests. And the person who never invests never builds wealth. Sometimes the smart move is to recognize that good enough beats perfect. But that's a hard lesson for people who've been rewarded their whole lives for finding the single correct answer. Here's the twist. Scammers specifically target intelligent people. And it works. Bernie Madoff's Ponzi scheme didn't prey on the financially illiterate. His victims included sophisticated investors, hedge fund managers, and even the owner of the New York Mets. These were people who understood finance. That's exactly why they fell for it. Madoff's strategy was brilliant in its simplicity. He didn't promise outrageous returns. He promised steady, consistent returns of around 10 to 12% per year. That's believable. It's roughly what the stock market returns long-term. But Madoff's returns were suspiciously consistent. No down years. No volatility. Just smooth, steady growth. Unintelligent investors might have just taken the money and been happy. But intelligent investors? They wanted to understand how it worked. So Madoff gave them an explanation. A complex option strategy called a split strike conversion. It sounded sophisticated. It used jargon. It was just plausible enough that smart people could convince themselves they understood it. This is the curse of knowledge working in reverse. Intelligent people assume that if they can follow the logic of an explanation, it must be legitimate. They don't consider that the explanation itself might be designed to exploit their intelligence. Robert Cialdini explains this in his book Influence, The Psychology of Persuasion. One of the key principles of persuasion is authority. When someone presents information with confidence and uses technical language, we assume they're an expert. Smart people are especially vulnerable to this because they pride themselves on recognizing expertise. Madoff ran his fund for decades. He was a former chairman of NASDAQ. He had all the markers of authority. Intelligent investors saw those credentials and thought, this person operates at my level of sophistication. They never stopped to ask the simple question that would have exposed the fraud. How is this actually possible? Harry Markopolos, a financial analyst, figured out Madoff was running a Ponzi scheme in 1999. He submitted detailed reports to the SEC multiple times, but because Markopolos wasn't in Madoff's social circle, because he didn't have the same Ivy League pedigree, he wasn't taken seriously. Intelligence can become tribal. We trust people who seem like us and dismiss people who don't. regardless of the evidence. Madoff's scheme finally collapsed in 2008, but only because of the financial crisis. He had stolen approximately $65 billion. The smart money lost everything. So how do you escape these traps? The answer is to separate intelligence from wisdom.
Morgan Housel makes this distinction beautifully in The Psychology of Money.
He writes, "Doing well with money has little to do with how smart you are and a lot to do with how you behave. Intelligence is about processing information. Wisdom is about recognizing which information actually matters." Here are 3 practical reframes. First, embrace simplicity as sophistication. Warren Buffett, one of the most successful investors in history, doesn't use complex models. His advice? Buy good companies and hold them for decades. That sounds boring to intelligent people. Boring is the point. The goal isn't to impress anyone with your cleverness. The goal is to build wealth. Sometimes the smartest thing you can do is pick the simple, proven strategy and stick with it. Second, automate to eliminate decision fatigue. Intelligence makes you want to optimize every decision. But every decision is an opportunity for bias to creep in. Set up automatic transfers to your investment accounts. Choose a low-cost index fund. Let it run. Remove your intelligence from the equation. The research is clear. Automated investors outperform active decision makers over time. Third, seek disconfirming evidence. Smart people are good at building arguments. Train yourself to argue against your own position. Before making a financial decision, write down all the reasons it might be wrong. If you're considering buying a stock, force yourself to articulate the bear case. If you can't find any flaws in your reasoning, that's a red flag. It means your intelligence is being used to rationalize rather than analyze. Remember that opening story? Long-term capital management collapsed because Nobel laureates couldn't imagine their models were wrong.
The antidote to overconfidence isn't self-doubt. It's humility.
It's recognizing that markets are complex adaptive systems that will always surprise you.
Intelligence is a tool. Like any tool, it can build or it can destroy. The question isn't how smart you are. The question is whether you're smart enough to recognize when your intelligence is working against you. Sometimes the most intelligent decision is to admit you don't need to be intelligent. You just need to be disciplined, patient, and humble enough to let time do the work.
If this video made you question some of your own financial assumptions, hit subscribe. We explore the psychological traps that keep smart people from building wealth. Next up, why the people who know the least about investing often make the most money.